Good morning, everyone. Welcome to this update for global stocks and commodities for the 13th of May. We certainly saw a shift in sentiment in the last week. Up until then, since the correction started in February, we've been seeing a tendency for people to want to sell for any reason at all, and it took an incredibly positive earnings report for there to be any response in the market at all to the positive side. So it was though investors were looking for reasons to sell. And things such as the trade wars and the Middle East were really dominating. But now we've seen a significant shift now that earnings season is starting to wind up, and it's been a very, very good one. And we're now seeing the market in the last week really turn around and start responding much more positively to the news. So let's jump in and have a look in this update. Just renewed strength across the board. And we've got the situation now where reality is winning. I think up until now we've had every reason for the market to rebound, and it didn't want to. But now the reality of earnings, as I've said all along, at the end of the day, earnings wins, and earnings have just been too strong to overcome all the negatives that have been out there. We'll have a look at the normal stock and commodity trend update. And last week in Portfolio Analyst, I did something a little bit interesting, and I looked at some stocks to buy and also a stock to avoid. So really comparing two stocks on the surface that looked very good. They were both in favour, but one I would support and one I wouldn't. Now, market sentiment, we're still seeing headlines such as this is the peak in earnings, the best is behind us, et cetera, et cetera. The media are rolling out all these catchphrases, but the actual reality is that this earnings season has given us just shy of 25% earnings growth. Revenues are also up, so this is not just a story about the tax cuts, which is, of course, a one-off benefit. Revenues are up quite well. A lot of companies, a high proportion of companies, have beaten on the revenue front as well. So this is just good, solid corporate performance. Retail sales are now starting to trend strongly higher, so that's a bit of a change. We haven't really seen that kicking in a significant way up until now. We're also seeing very solid outlooks into 2019, so the companies are pointing to continued good growth. And we've still got reasonable valuations. The S&P is still trading on an average PE of around 16.5, which is not onerous at all given where interest rates are. So that's the reality. It absolutely is swamping out the headlines, and investors are starting to realise it, and the market was well supported last week. So the S&P went up 2.4% for the week, which is the best week we've seen in quite a number of months. Several moving averages were broken through, the 20-day, the 50-day, so they were defeated. The trend of lower highs has been broken, so no question that technically the market is looking a lot better. And the strongest industry groups are just absolutely bolting. They're much higher than they were before the start of the February correction when we came into the start of this week, and they had an absolutely stellar week. And also the Russell 2000 for small caps also looks very poised for a breakout to new all-time highs as well. So earnings season, great. Market now starting to respond to that, and technically looking very good. Now, the US dollar went up early in the week and then came back again to finish flat. It had been heavily overbought, so that wasn't a real surprise. Let's jump in and look at some charts now. We'll start with the S&P, and you can see that I don't have the 20-day moving average on here, but you can imagine that that's even more responsive. So the price has beaten the 50-day now quite clearly. The support of the 200-day moving average held on 4 occasions, 1, 2, 3, and 4. And we've now also broken this string of declining highs, 1, 2, 3, 4, and now we've edged ahead of that peak from the 17th of April. So technically the market back on a really good footing, and it'll be interesting to see what happens when we get up to this resistance here around the 2800 mark. That'll be the next test for the market. But you'd have to say at the moment the odds favour the market continuing higher. Let's look at the Russell. So the Russell also, the NASDAQ, I beg your pardon, also broken the 50-day moving average, also broken to a new short-term high, and is definitely back on trend. So that's really quite positive. If we look at the Russell now, okay, so you can see the Russell, as opposed to the other indices, is basically back at all-time highs, really knocking on the door. And this is a really positive sign that that the small caps are doing as well as they are. So this looks absolutely poised to break out. It's had a great run over the last 6 or 7 days, so we might just get a little bit of a pause first. But the signs are this is going to break out and the market's going to be on another rally fairly soon. So quite a lot of positive in America. This is the US dollar index. You can see we had a great surge from just under 90, got to 93, pulled back a bit the last couple of days. Yeah, the US dollar looking a lot more positive now. Just while I'm here, let's look at the Australian market. So this is the ASX 200. We actually equaled the high that we had set back in early January, and that was the highest price that we'd seen since 2008. So we're finally starting to see something a little bit more positive for the Australian market. But look, I'm still very concerned and wary about the banks, and the banks are going to be a big drag on the index. So I really think that our index is going to continue to struggle. Let's look at the materials index. So this is what's really been spurring our market along, BHP and Rio. But it's quite overbought now. So we've actually had a breakout in those major miners, and also Woodside has done very well. But if you look at the banks, you can see we broke this very important support on the banking index, really key support. Rallied back to it, fell away again, created a lower low. We've had another retest of that breakdown, which is not unusual, but you can see the banking index really came off the boil on Friday. And if we look at CBA on a weekly chart, you can see that we've got a series of lower highs for CBA. We're still in this range that we've been in since August of 2015, so getting on for 3 years. But it really is looking very weak, and the price of CBA is well below its moving averages. So I wouldn't be at all surprised to see CBA break support. That will bring in a fair degree of technical selling, and I think that will probably involve the other banks as well, and that'll be a real drag on our index. So I wouldn't be getting too excited about our index at the moment. And finally, let's just look at the Australian dollar. So quite a steep decline from the end of January, where it was trading at 81. We got down to the low 74s, had a bit of a bounce and finished the week at 75.5. But you can see we've now broken these lows. Technically, we're still in a big range, but I think there's a good chance we might explore the lows down closer to 70 cents by the end of this year. So just to recap, the Aussie dollar up to 75.5. And interestingly, despite the fact that oil has been so strong and iron ore has been so strong, the bit of commodity strength, or the bit of strength we've seen in the dollar, is really just responding to the fact that the US dollar came off. So we're not really seeing a response from the Aussie dollar to commodity strength as I read it. Our index gained 53, just under 1% for the week. It was our 6th weekly gain in succession. But I just worry a bit. There's a lot of very positive sentiment around our miners now, around BHP and Rio. The brokers that had been not supporting the stocks are now jumping on the bandwagon and recommending these as a buy. They're short-term overbought, so I wouldn't jump into that boat at this stage. And of course, the banks were down sharply on Friday. Precious metals, gold was up by $5 to $13.20, and that's really just a currency move story. And the global majors, when we look at the GDX index, there's really just no momentum there as yet. But certainly local Australian producers are doing very, very well. Let's take a look at the gold chart. So that's the gold chart on a daily basis. Made a bit of a gain. It was flat in the early part of the week when the US dollar went up, but it did pick up a bit of momentum as the US dollar came off. That's it looking at it on a weekly chart. So there's still really very, very little happening. And we've got to get over this 1380 level, I think, before anything's going to materialise. If we look at GDX, this is on a weekly chart. You can see, again, we've just been stuck in this very tight range on GDX between 2070 and 2550. And that's been the case for nearly 18 months now. So very, very little happening with the global majors. Turning to other commodities, copper was up slightly and crude oil was higher again to 70.51, so managed to hold above the $70 mark. And the relative strength across the energy sector in order, the strongest industry group is refining. The next is production and exploration companies, and then the third one is the services companies. So services are still doing okay, but they're relative to the production companies, they're not doing as well. So let's take a look at a couple of those charts. We'll start with XLE first of all. So this is XLE on the Amex exchange, and if we get a big picture perspective of this, you can see we're way off the highs of 2014, but we're certainly getting back there. So those highs were around $100. We're trading around 80, and we're getting towards the top of that trading range in the energy complex now. And with earnings growth in energy really, really strong, it's somewhere up around the 80 or 90% mark on a year-on-year basis. I would expect to see a breakout in XLE. And let's look at OIH, which is the ETF covering the services sector. As you'll see, it's not near the top of the range as XLE is, but it certainly is starting to respond more positively. There's the spot copper chart. Again, we're just stuck in this range. We've been in this range now for some time, between $3 and $3.20. And there's the very strong upward move in crude oil. So to wrap it up, earnings season hasn't quite finished yet, but it's been a major success no matter what happens in the last week or so. And technology sector has again justified the price gains. That's been very, very strong. The earnings growth has been in excess of 20% across that sector. Portfolio analyst this week, I'm going to be looking at a lot of US consumer discretionary stocks, because that has been another real indicator of the strength of the US market, the fact that consumer discretionary stocks have just absolutely beaten the daylights out of consumer staples. So that's another very positive sign. There's my contact details for those who aren't members, and I look forward to being back with you next week. Cheers.